Welcome to the Campground Catalyst Podcast, the show dedicated to fueling success in outdoor hospitality. Whether you're an outdoor adventurer, a campground owner, or looking to build your legacy in outdoor hospitality, you're right where you need to be. We're here to guide you through the fascinating world of campground management, unique real estate strategies, and the gratifying opportunities created by outdoor hospitality. Our mission is to inspire and equip you with the knowledge and insights you need to build a successful business and create a legacy worth leaving. The Campground Catalyst Podcast is proudly sponsored by Beyonder Camp, your trusted outdoor hospitality experts. Subscribe now, join our active online community, and let's ignite our passions and potential together.
Welcome to this next episode of the Campground Catalyst Podcast. I'm one of your co-hosts, Don Spafford. I'm here with my other hosts in my team here, Adam Lendy, Robert Earl, and Justin Hoggett. In today's episode, we're focusing on the Legacy Builders section. We'll be discussing something that's probably not super exciting for most people, but is to probably one of your better benefits of being a campground owner. And that is discussing depreciation and how you can take advantage of that to save a lot of money in your taxes, which basically increases your bottom line income for your property. So to start this off, just real quick, Adam and Justin, you guys are the two founding partners of our company of Beyonder Camp and Beyonder Holdings. When you guys first started off and bought your first property all on your own, did you even have any idea that there was depreciation available for campgrounds?
You know, Don, honestly, when we got in, we knew about depreciation in other assets we'd been in before, but we completely underappreciated the opportunities that were available in our campgrounds. You know, it's just, obviously we know we can't depreciate land itself. So we looked at this as being a mostly land play, and we failed to appreciate just how valuable all the underground infrastructure and even the on-ground infrastructure was to a picture of depreciation. So yeah, we horribly underestimated. What do you think, Justin?
Yeah, very simply put, yeah, we had no idea. And I've been through this process with my apartment buildings and realized that there's a great opportunity here. And then even our partners in the space, they go, oh yeah, you should be able to get, X dollars from this and depreciation. And they were even blown away. So an incredible opportunity, and we do it on all our properties. And yeah, Don, yeah, good question, but definitely a great benefit as we help our tax situation.
Sure. And for those who don't know, let's just maybe explain a little bit about what depreciation is. And again, we'll put out this disclaimer. None of us are CPAs or tax advisors, so we'll do the best of our ability, but please speak to a professional if you have more questions. So depreciation is really a benefit provided by the government to incentivize investors and owners to go out and buy more property and provide real estate and other things to the common people. And with that, what it is basically it's a paper loss. So they assume that over time, the asset that you have, whether it be a building or otherwise, will lose value through its usage. As of course we know in real estate, most times the values go up over time. So it doesn't make sense that they depreciate like a vehicle would, but in the government's sake, on paper, they will depreciate and lose value over time, and you're able to take that loss in value directly from your basically your income on the property as a loss per se, which again is not necessarily a loss in the business income, just a loss on paper, which helps you save a lot of money in taxes. And part of that is what's been the last several years. The government came forth with a accelerated depreciation where you can bring forth up to 100% of your bonus depreciation in year one, which can save you a ton of money. And like you guys, myself, when I first got involved with this, people would ask me, like, what kind of depreciation is there? I'm like, I don't know, probably not much. It's like you said, it's mostly land. You wouldn't think that you're not depreciating a large apartment building or something. But as I started talking with the cost segregation experts, who are the ones that do those kind of studies to know how much of that depreciation can be taken in year one, they told me that, yeah, there's actually a huge amount available. I'm like, oh, really? Tell me more. So we started digging into that and discovered that, yeah, campgrounds can provide very high depreciation. And we can get into a little bit about the reasons why that is. And we, of course, have ourselves held some webinars with a tax professional who has explained that in more depth. But let's bring it to the panel here, the group. What do you guys understand about how that works and why that's such a good benefit?
See, I thought it was that when you had a rental house, you were supposed to tear it down every 27 and a half years and build a new one. Isn't that how that's supposed to work?
Yeah, or should fall apart within that period of time, yeah.
Yeah, exactly. No, but to your point, Don, I mean, there is a lot of variance in it, and of course, like I said, when Justin and I naively looked at this early on and said, well, there's probably not much there. Had we just bought raw land, there would have been nothing to depreciate. If there was nothing on it but, grass and anything that grew naturally. But the more you put into the property, that's where it becomes depreciable. Just like in the apartment building example Justin gave, every one of those structures has that ability because those things have an expected lifespan. And in our campgrounds, of course, there are varying amounts. Our best property that we got bonus depreciation on is one that has concrete pads, concrete roads, full hookups at every site. So there's sewer at every site, all the electrical and water infrastructure, multiple buildings on the property, multiple swimming pools, so all of those things add up to, very high level of depreciation. And that particular property in a very dense setting, it's all very tight. And that's one where I think we had our expectations massively exceeded. That was an extreme example. But even then, on our average campground, I mean, obviously, you get one that's got gravel roads, gravel pads. There's not quite as much depreciation on that. And then of course, like I said, it just varies on the amount of buildings and structures you have because it's those improvements that you add to it are the things you depreciate.
Exactly. Yeah, everything has their set timeline. Would it be 30 years, 15 years, 10 years? And that's kind of why you do that cost segregation study. Those experts can kind of piece those things out to put them in the individual categories that they fall under. And then everything that's not on that long-term, 30-year depreciation can all be, again, depending on what time you listen to this and what laws are currently available. When we had 100% bonus depreciation or 80%, 60%, whatever, all of that does not fall in that 30-year category can be brought forth in that first year depreciation, which gives you that big bonus up front to save a ton of money. Robert, you're also a real estate professional from your past here, and what's your insights and how's it been a benefit to you and your clients in the past for depreciation?
Well, it's definitely something that you look for moving from residential real estate, doing a 1031 exchange and moving your investment into something that's a little bit more commercial in nature. I was first exposed to this, believe it or not, and I think I've referenced this in another episode, through auto racing. NASCAR and the track owners really lobbied for there to be accelerated depreciation and got those tax laws on the books. That's also been used, the Atlanta Braves, when they recently built their stadium. It's a way for the local municipalities to be able to help fund the improvements that are being done in the community as well. And a campground really falls into that. I had the opportunity here at one of our campgrounds to walk the property with one of the analysts that was putting together one of those cost segregation reports and really look at how they looked at the property. And it made me approach management a little bit different from the standpoint of when I'm looking at a repair, it's not just putting duct tape on it. Maybe this is the opportunity to actually do an improvement. And when we do the improvement, then we get the tax benefit on the back end of it.
Yeah.
Does someone use duct tape to fix things? Is that a thing?
Not around here.
I think MacGyver does that.
Wait, what do you guys have in your toolbox?
Yeah. And you bring up a great point there too, Robert. Like for a lot of people, I think you look at the upfront expense. Like, I don't want to go spend $100,000 to upgrade my pads to concrete versus gravel or whatever. But when you look at the incentives that are available, I mean, you could get back a great portion of that back in these tax savings, which could really, in the end, benefit you much more than the upfront cost to put it in. And that may be worth some people to actually go forth and take those expenses, because one, it's going to improve your property anyway. It's going to make it nicer for your guests and just overall better appearance. But it's also going to bring you a lot more in tax savings that could, in the end, benefit you much more than leaving it as is, which would be a better option than duct tape.
and much definitely, and much better than trying to pay yourself as the owner out of the park, or trying to avoid certain taxes as to one of the, if it's spouses that are owning the property or partners, one of them is on the books and one of them isn't on the books because they're trying to do something from the tax benefit there. This is just really something that's unexplored for a lot of the campground owners and campground investors investors that get the opportunity, because what I found, the part that I was exposed to coming to Beyonder, was how the investors also benefit from that. And so if you want to talk about that a little bit more as well.
Yeah, for sure. But definitely from the investor perspective, it's fantastic because it again, not only offsets your income, it can essentially reduce your taxes to zero in many cases. And going back to a comment you made earlier about a 1031 exchange, in some conversations I've had with other again tax professionals, most people, they think the 1031 exchange is pretty much your only option really to save taxes when you sell a property to invest in something else. And that's not really the case, depending on the situation. So a very high profile CPA that I'm aware of told me that she doesn't even bother with the 1031 exchange. She'll sell off the property, or when the property sells and gets the money from it, she'll just find another property that's going to get very high bonus depreciation year one to invest in that to offset that income and get the same result without all the hassles and the time frames and the stress of a 1031 niche. In many cases, people may end up in a bad deal because they're rushed to get it somewhere to save on those taxes. And I myself have done that as well. I sold a property in 2022, and I just invested it back into our Beyonder Holdings fund because I saw that tax depreciation was going to be probably more beneficial to me than trying to find another property to use it for a 1031. But yeah, that's a fantastic advantage. And as well, going back to the campground owners, besides the improvements you make that would save you on these taxes, you also can save on the things you are removing. Like, so if you've not done a full cost segregation before on your property, get that bonus depreciation up front. Let's say you rip up an old pool, replace it, or tear down an old building to put something else in place. Anything you tear down or rip off and remove, even as far as like removing like an old mobile home or something sitting there for years, remove that off their property. Those things can also be fully depreciated by disposition. I think they refer to it as. So again, something that you should refer to a tax professional about. But and along those lines, I think all of us here are aware that not all CPAs are the same. So just because you talk to your CPA and they tell you one thing does not mean it's the right answer. Definitely check around because not all CPAs are fully, let's say, up to code or understanding of depreciation, and especially in the case of real estate and rental properties or investments. So definitely check around and ask several people before you finalize on your answer for that.
Yeah, I'm going to say I'll echo that, Don. The tax professional you hire is going to make the biggest difference in this. When I first got into real estate, investing, my first rental properties, I didn't have that expert guidance. The best advice I had was that I was able to take a nominal amount of depreciation. I didn't know how it was calculated, and it was done a 27.5-year schedule. So it was. I found out later, of course, that I was clearly missing a huge opportunity by not having that cost seg done. Now, of course, there's a give and take to this, because the other side of it is you do have a recapture event at some point in the future. You can carry that forward, as we talked about with the 1031 exchange, et cetera. But eventually, if you cash out, you're going to have to pay that up. But the point being, there's a big opportunity. And one common phrase we hear from a lot of our investors at Beyonder anyhow is that we get investors to say, I need depreciation this year. And they're usually coming to us in December going, I got to get this money into something, I need depreciation. And of course, this is something that a lot of business owners and self-employed people, real estate professionals aren't thinking about. Is if you have a really good year in business, you're likely to have a really good tax bill with the IRS. So if you're able to offset that, as you mentioned, Don, I paid nothing in taxes last year, and I actually have a carry forward left for the next year legally, because of the depreciation we get out of our properties. And that's the big opportunity. And campground owners in the past few years have had exceptionally good years, and the IRS is aware, which is why they probably paid some exceptionally high bills if they don't know how to get around that. Now, the cool thing about that is if you've had a really good year and you haven't done the cost seg yet, now there's no better time to do it than now. Like, do it now while there's still some bonus depreciation left, because as it stands right now, that's phasing out. There's talk that it might phase back in, but we don't have anything definitive on that yet, because that can offset the gains in a very, very big year, and then of course carry forward to future years.
Right. As Adam's saying, like TurboTax or the likes of these softwares aren't going to do this for you. They're not going to point it out to you. You're not just going to figure it out like, oh my God, look at what I can get. Right. I mean, I know, at least based on when I was doing it myself a long time ago, you'd put in a number and be like, how does that affect things? Right. And there's kind of a game how to make your taxes work. But to the point of all this is really making sure you do have the professionals, the CPAs, but also the engineer that has to do these cost segs, because you're not going to be able to do this yourself. You do need the right professional and enlist the help to get it done. And it's not cheap, right? I mean, you're still going to spend a few plus $1,000 on this, but the whole premise is what you gain from that getting done. And money now is better than money later, right? And kind of heard that before, but and then we get the right strategy in place. You're going to have that depreciation into your investments, and then you're going to roll it into the next one, and it's going to kind of gamify the whole thing too. And you get a little bit of flack from people out there that don't understand investing a little bit, and they go, well, how are you not paying taxes? I haven't paid taxes in many years. And as Adam pointed out, like, he's still got a carryover. And you can do this retroactively too. It goes back, I think, 3 years ago.
That actually is not, that's no longer.
No longer?
Yeah.
Okay. Well, it was a few years ago, and it helped me out a lot. I was like, wow, this is a pretty big check I just got, and
I believe it was after 2019 that went away, the retroactive. Okay. It's all forward now.
All forward. Yep. So anyway, it can help, and would highly suggest it.
Now, you mentioned not be able to do it yourself, Justin, but the first one you did, you did yourself, right?
I did. I still had to have an engineer review it and submit it because that's who signs off on it. I did most of the legwork, which is the biggest mistake of my life, I'll say, because I had to do the pictures and the measurements and the submissions, and because they look at everything. It was like every nut and bolt of this thing, and it was crazy. But yeah, but Don, I think, can explain a little bit more on what they're looking at. But Robert, it looked like you were about to say something.
Yeah, I was going to bring up when the analyst was out at our property and they were looking at, say, a bathhouse. They did look through the stalls and the sinks and the conditions of the entire building. But you brought up if I were to dispose of that, is it because I'm accelerating the useful life and it's no longer there and I'm making some sort of improvement? Is that why I get to take that advantage, Don? Because I think that's a misunderstanding. It's one of those, I know the answer, but I'm kind of teeing you up for that as to if we get that mobile home off the property, then why do we get to make a claim right now?
Yeah, well, that's a great question, Robert. And again, we're not tax professionals here, but I believe it's just you're removing what's considered an asset, right? Whether it be a useful asset or not, it's still an asset, something that has value on the property. Therefore, by removing it, you are supposedly either replacing it with something or had to remove it because it's no longer has a useful life, whatever it may be, and therefore it can be removed off. It's like this was an expense, more or less. So you get that again. Accelerated or technically a form of depreciation from the disposition of that, and that could also include even the shingles on a roof. If you replace a roof, there's lots of different things. Again, talk to a tax professional that can explain it in details. But as far as I'm aware as well, that anything that's not considered a fixed structure, like the beams and framing, it's gone for so far now. As I've heard that even drywall now can be depreciated as well because they consider it's attached with screws. It can be removed. So there's lots of things like like Justin was saying, they got to go through a fine-tooth comb and they review every single thing, every single pipe, every single screw, everything, that they know exactly the value of those and what it costs to replace it. Those can all be therefore depreciated at different depreciation schedules.
Yep. Perfect. And of course, that's the idea, is the different schedules, and the premise of the acceleration is just that we're taking those longer term, or those nearer term things rather. It's correct me if I'm wrong, Don, is it the 6 and the 9 year schedules and accelerating those up, and then of course our 15 and 27 and a half years, those stay on their schedule.
Yeah, I think it's a 5, 10, and a 15. I'm not 100% certain on here, but
right.
But that's what they are, the 5, 10, and 15. Then you have your 27 and a half or 35 and a half, whatever it be for commercial. Those, anything that qualifies in that, like structural, really, those stay in that long term and cannot be accelerated. But you still therefore appreciate those over that period of time as well.
Yeah, maybe the government's figured out that tenants and guests are hard on things. That's why they do this. I don't know.
Yeah. And going back to a previous point, I mean, if you have not done a cost segregation study before on your property, you can still do one now. And as far as what I understand, and again, I could be wrong here, but it's not based on the year you do it. It's based on the year you bought it. So if you purchased your property in, say, 2017, 18, 19, whatever, you do cost segregation today in 2024, you can still qualify for that 100% bonus depreciation based off when it was purchased. Possibly. Again, I'm not going to put my name on that, but from what I understand, that is the case. So make sure you look into that. And again, you could be sitting on a gold mine right there that you didn't even realize you had to save yourself from paying taxes. And again, could be something that maybe can be somewhat of a political topic. People get hot about saying the wealthy don't pay taxes, but it's not that they're not paying taxes. It's the tax code is written to benefit the people. If you know how to use it, you don't have to be wealthy or rich to do it. It's just there's wouldn't even call them necessarily loopholes, but just the way the tax code is written is actually for your advantage if you use it to your advantage, versus just being an employee and not do anything about it.
I feel like we've talked about it before, but it's the idea that the tax code is written to incentivize businesses to do things that the government wants them to do. So, if you don't like the fact that some of the wealthy in real estate aren't paying taxes, I guess you can, change how you vote. But, those are put in place to incentivize us to provide, amenities that, that benefit the public, and they come in forms of housing or recreational facilities like ours. But, we're playing within the rules, none of us are worried about going to jail. I sleep fine at night, knowing that I'm not breaking the tax code and I'm paying my fair share.
Yeah, there's a great book called I think it's called the Win-Win Wealth Strategy by Tom Wheelwright, very well-known expert in taxes and stuff. Written several great books, but he talks about in that book that essentially we are partnering with the government. The government steps in as our partner on these deals, on anything you purchase, because they are not directly providing money up front to purchase it, but they are essentially, like you said, providing that incentive to do it and partner with us to save that money, basically to do the things that they need done and don't have the manpower or the resources or want to take the time to do. I mean, they could, go through a government entity to build houses and everything, but that would take forever and not be done very well. So they just like, hey, why not we just give an incentive, let other people do that and deal with that, so we can focus on other stuff, infrastructure and all that.
Yeah, perfect.
So if you looked at this as a pie chart, Justin, Adam, as you're evaluating a property, what percentage of it would you be factoring in that it has that potential for depreciation? Is it 30%? Is it 50%? What are you looking at as you're evaluating the deal? If you could put a number on it, and as a follow up to that, with a previous owner, if they haven't been doing this, does that have any factor on you coming in to purchase the property?
That's a good question. So as it relates to, first off, answer the question on the previous owner first, because it depends on how you buy the property. So if the previous owner was, say, holding the property in an LLC and you bought their LLC by their, taking the property with it, you would actually be accumulating their depreciation. So you wouldn't have that depreciation. You'd be basically picking up where they left off. So if they had fully depreciated the property, you'd be sitting on a potential liability, at the time of selling it, which is why when we buy properties, we don't buy them that way. That's something I would encourage anybody who's looking to buy a campground to be very cognizant of, because there's a lot of incentive for an owner to want to sell their LLC versus selling the real estate, again, so they can avoid that burden. It's much easier for them to It's much easier for them to wipe their hands and walk away from the LLC, leaving you with a whole bag of issues, not to mention the other legal ramifications of you don't know the full history of that. You're basically buying an identity that you might not know what it's been involved in, but that's a big part of it. So yes, when we look at buying the property, we buy fee simple typically is what we're looking at, meaning we're buying a deed to the property, which means we more or less end up with a clean slate, because that former owner, if they have taken depreciation, there's a recapture event at the time of sale, so they're going to be paying the government back. And then, of course, we start with a brand new, like I said, it doesn't matter if the property's 30 years old, 50 years old, 1 day old, we're going to do a cost seg study, and we're going to basically pick up based on what's on the ground today.
That's a good point. So even if somebody did a cost seg study before the previous owner and you buy it today, you can still do another one again and still get those same, depreciation on the same property. It's not like it's a one-time thing and it's been depreciated, you'd never get it again. It's just per owner, right? If you buy it today, sell it tomorrow, whatever, each owner that buys it can take that depreciation again and again and over again. One point I wanted us to make sure that people are aware of, a lot of these campgrounds may be family owned for generations. And it's not that, if you take that depreciation at some point, you have to pay it. And that's only if you sell it. For example, if somebody were to, if I were the owner and I were to pass away and I die, right, and I pass it on to my children and they take it over, they don't want to own it, they decide to sell it, depending on when they sell it, there potentially could be zero tax liability for them because that they gets what's called a step up basis, meaning that all the things that I've owed on it and depreciate on it doesn't matter when the day I die and it passes to them, it gets valued at the current value today, not what I bought it 50 years ago for. So that's a one incentive to basically, instead of selling it before you're getting ready to die, to give some to your children, just wait, let it pass into them and let them sell it, and save a huge tax bill.
Yeah. So to answer Robert's question, I glossed over part of it, which was how much we factor this in on a purchase decision. I will say that typically when we're looking at it, now granted, our viewpoint is a little different than what a lot of our listeners might be, because we, of course, have to consider the investor side of this thing too. If somebody's looking to buy and own their own campground, this might be a much larger consideration for them up front, especially depending on the health of the business and what sort of first year they might be looking to have. In our case, it's we kind of look at it more as gravy. This is something that just might sweeten the pot for us. It's not something we rely on going into a deal in our underwrite because, again, there are a lot of factors that can influence it. Again, we can get an idea, a property that's got, again, high amenity, so pools, lots of buildings, concrete roads, concrete pads, all that sort of stuff. Any structures on, those are going to have the best chance at depreciation. It's something we look at as a nice bonus surprise. We don't promise our investors any certain amount of depreciation. We can give them, tell them that we expect a reasonable amount, or this one could be a very good one. But, we also don't want to speak out of turn, because until that person gets done with their study, we really don't know what it's going to be. It is definitely a wild card.
Yeah, Don, maybe do you have a specific percent that they've told us? I know that you've studied these a little bit more, but
yeah, well, I don't think that they of course always cautiously say it depends. They never, no tax professional or attorney ever wants to give a definite answer. It's always it depends, right? So there's a lot of factors involved there, and of course, as right now, as that bonus depreciation is coming down each year, that's going to change in the end as well. But typically, I say we'd say that at a low end, probably just around 60% is kind of a good average number to base it off of. Even when they go to do the study, they'll give us a preliminary study first, kind of based off the location and some rough idea numbers, what we give them. And they always say, okay, well, maybe it's going to be about this. Then by the time they finish the study, it's always usually much more than that as well. So they themselves are very cautious and conservative up front to not give too high of expectation, and basically just under promise and over deliver. And that's kind of what we try to do as well for our investors, is under promise and over deliver. We know that what we expect for returns and cash flows and the benefits they can get, but if we can satisfy them with what our low expectations are and exceed that, then that's going to make them even more happy, and of course refer their friends and family to come in and invest more with us too.
Yeah, and then to make a point too is that the every year you can add the items that you've put into the property, so that you reevaluate it every year. It's not a restart, but it is an add in addition to, so that you can continue benefiting from that accelerated depreciation. And then and another note I wanted to mention, a little bit on the acquisition side. When we get the P&Ls from a lot of properties, it includes the depreciation on their P&L and on their taxes, and that is an add back. You want to make sure that you're not seeing that as an expense on the property, and making sure you're looking at the P&L correctly, because it will come off that bottom line as a loss, right? So it's not a true loss; it's actually a benefit. But just take note, if you are looking at properties and P&Ls, that's going to maybe point. It's going to be on there. So
that's actually a good way to visualize what the benefit will look like for you. So I think it's worth mentioning is that if you're looking at that P&L, of course, yes, you may have somebody tell you that this is an add back depreciation, which increases the NOI, which makes the picture look better when you're looking to buy the property. But look at that person's depreciation. If they're doing it right, if they've had a cost seg done and they're getting that bonus depreciation in there, if you're seeing it, or even just the accelerations in it, then you'll have a picture of how much it lowers what they're reporting to the IRS they need to pay taxes on. So that could be a very big benefit right there. But yeah, fair point in the underwrite. So No, great discussion today. I mean, it's if you, on its face, if you didn't really know what depreciation was, it probably sounded like a boring episode. But hopefully, you found the excitement in it we did. Which I'll tell you, I mean, I would have owed the government a heck of a lot more money the last couple of years than I've paid. So, just taking advantage of what is in the tax law code, what's available to you now, is certainly going to be beneficial for business owners in the short term. Because even though there's that recapture event later, like Justin said, it's the money you have today, not tomorrow, and it's what you do with that money. So, of course, putting that money to work today, will realize a better future for you.
Yeah, definitely. Put some more money back into your pocket right now that you can redeploy, put back in business, invest, whatever, to in the end earn you much more than what you would have paid in taxes anyway.
That's right.
So great. Well, thanks for everyone for your input on this this episode today, and hopefully it's useful for those that listen to it. And obviously feel free to reach out to anyone from our team. We're happy to give you referrals to some great tax advisors if needed. And we look forward to talking to you in the next one.
Yeah, be sure to visit us on campgroundcatalyst.com. Submit any questions you've got, show topic ideas, join the Patreon group, and make sure to subscribe and share.
And ask questions. We're here for you.
Thank you for joining us on this episode of the Campground Catalyst Podcast, where we take you behind the scenes in the fun and gratifying world of outdoor hospitality. We hope you were inspired by today's show and better equipped to take the next steps in your journey. Remember, you can continue the conversation and connect with fellow enthusiasts by visiting our website and joining the Campground Catalyst community on Patreon at campgroundcatalyst.com. There, Patreon members get exclusive access to special listener perks, they get their opportunity to engage with the host, and they get their questions answered on one of our future upcoming shows. The Campground Catalyst Podcast is proudly sponsored by Beyonder Camp, your trusted partner in fueling your success in outdoor hospitality. Until next time, keep both your campfires and your passions burning.